Welcome one and all. I hope you all had a great weekend. As you can imagine, my Sunday night was fantastic as my favorite NFL team, the Los Angeles Rams, walking away with a Lombardi trophy. Also, congrats to those of you who are Cincinnati fans. You guys put up a great fight. A lot to be proud of over there as well. Now, besides taking the victory lap here, you might be wondering, well, what does that have to do with the stock market? Not a whole lot, but I will say there is what's known as the Super Bowl indicator that suggests when the NFC wins, which the Rams are part of the NFC, that the stock market has a better chance to outperform during that particular year than if the AFC were to win. So maybe we've got that going for us here. We'll see. For today, we did have a very bullish day with the S&P 500 up nicely, well over 1%, over 80% of the components finished higher, and that was largely due to some relief of tensions between Ukraine and Russia. So whether that continues going forward, we'll all find out together, but we'll take a look at that, see what it means for our posture. Then we're going to get into a trade application example where I wanted to feature a bear call spread on a very well-known technology company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 15th, 2022. First of all, welcome aboard to those of you who might be new. Remember to go over to our YouTube channel, click subscribe, and then when you're done with that, go into our description area down below and make sure you're signed up for our email distribution list. Not only will you be notified whenever we post these videos, but within those emails, you'll also see all the stocks within the S&P 500 that are giving you overbought and oversold cluster signals. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related presentations. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, it was a very bullish day on Wall Street. This is what 80% of the stocks within the S&P 500 being positive looks like. We've seen a few more of those red days like that lately, but here we're getting a little bit of a snapback rally here today. We were strong pretty much all day long and then had a nice little kick into the last, let's call it 10-15 minutes of the day when President Biden got on to talk about the Russia-Ukraine situation. So we'll see how long that lasts, but for today, we'll celebrate a nice day here, of course, being the Rams fan that I am and being thrilled with their Super Bowl performance on Sunday. A friendly reminder that when the NFC wins the Super Bowl, that generally bodes well for the stock market returns that year. Obviously, that's not something that happens every single time, but throughout history, it has been shown that the NFC team winning has done better for the market than the AFC team winning. So maybe, just maybe, the Rams can give us a little bit of extra luck here as investors later this year. So as you look at these various squares and rectangles here, a reminder that the bigger the square or the rectangle, the more kind of influential that particular security is within the S&P 500 itself. So the bigger ones are the biggest market cap ones at the same time. And so some of them that stand out to me today, Tesla, of course, catches my eye, up 5% here today. We also saw Nvidia up 9% here today. Semiconductors were actually the best industry group here today, followed by airlines and then automobiles there with Tesla again. We did see some red here in the form of energy stocks and then also utility stocks, and I'd also throw consumer staples in there, as kind of a distant third from that perspective. Otherwise, we had pretty consistently bullish price action across the board here today. A lot of that is a result of the cooling off of tensions between Russia and Ukraine. But remember, that could flare up at any moment as well. So this is the type of market rally that could be somewhat short-lived if the news headlines kind of flip the other direction here in the near term. So we'll all take a look at that here together. But on the whole, as you can see, very green day across the board. On over here to the normal part of the Thinkorswim platform now. Whenever we have at least a 1% up day, I like to show you this graph, which is chart 6D if you're a premium member following along at home. This will give us a sense as to whether we've been having more volatile price activity here recently. And so today was one of those 1% up days on the S&P 500, and you can see what that looks like from this green bar's perspective. Remember, when it grows higher in green from that black zero line, basically means that we've had a pretty strong day. And then, of course, the deeper the red bars go below the black line means it was a pretty aggressive down day. And so as you can see here, we have had more volatility here recently, where we've had quite a few days above a 1% return higher, and then lots of days down below of at least a 1% move lower, with a few of those 2% days thrown in there for good measure as well. But the point is, you look at all of this activity basically starting here right around the end of November, and then kind of compare that to what had happened maybe the 2 or 3 months prior to that, and you can see a distinct difference here between the aggressive trading we've been seeing here more recently versus this market that was effectively just lulling us to sleep in the summer and early fall of 2021. So it's been more interesting, to say the least. Now, naturally, when the S&P 500 is up, more times than not, you will also find that the VIX, or the volatility index, will fall, and that, of course, was the case today. Now, we did end at about 25 on the VIX. In recent years, 25 would have actually been considered still somewhat high, but what we've been experiencing so far in 2022, that's, of course, well off the highs of about 34 on the VIX that we experienced here just a couple of weeks ago. So we're kind of in the middle of the road in terms of volatility here, not extreme in either direction at this moment in time. Let's go ahead and take a look at some of our market breadth measures. And one of the things that I like to do is pull up the Visualize tab or the Visualize sub-tab within the Market Watch tab on Thinkorswim, and then pull up an index watch for the S&P 500. This will give us a general sense as to how many stocks were up versus how many stocks were down today. And you can see just over 80% of the S&P 500 components finished in the green here today, 401 out of 500. So a very good day there. Those of you that are long the stock market, which I would have to believe is probably the majority of our viewers, you're probably going to see some green in your own portfolio here today as well. Obviously, if you have a heavy smattering of utilities and energy, you might not have had as good of a day as others, but on the whole, most diversified portfolios today likely would have seen some nice gains there along the way. Let's go ahead and take a look here at our normal 4 grid now. And so for that, I'm going to go ahead and pull up chart 4B. And as you can see, it was a strong day for all 4 of our indices. S&P 500 up 1.58% today. Dow Jones Industrial Average was up 1.22% today. Now remember, they were the laggard today, even though over 1% is still a very good result. That was the lowest return here today specifically, but that is fairly typical when the Dow Jones has been the one that has not lost all that much to begin with compared to the other indices. When we have a big snapback up day, then they don't get a chance to rebound as quickly at the same time. You will notice that they have a weekly bearish posture at this moment in time. That's what that light pink color is telling us there. And as soon as tomorrow, if we do have a pullback in the Dow, we could fall to a strongly bearish posture. I say that because the intermediate line right now is at 50.24 and falling. And the way that this background color will work here is if it falls below 50.00 tomorrow, it will change to this darker shade of pink, which basically constitutes a strongly bearish posture there. So be on the lookout for that possibility as soon as tomorrow. Remember, the S&P 500 is already there. Their intermediate line is at 42 and falling, and so already below 50 in that case. So strongly bearish posture still on the S&P 500. Weekly bearish posture still on the Dow Jones Industrial Average, but a pretty solid chance of it going to strongly bearish as soon as tomorrow. Speaking of strongly bearish, you can see down below here the NASDAQ composite remains strongly bearish from a posture perspective as well, with its intermediate line at 35 and falling. And the NASDAQ actually had a very strong day. It was up 2.53% today. Russell 2000, kind of different than the rest of these all of a sudden. It was the biggest performer today. It was up 2.75%. We'll actually be talking about that tomorrow morning in my factor-based swing trading class when we discuss the low-size factor. But there's been a fairly decent snapback within some of those low-sized areas here recently. In fact, so much so that not only was it the best performing broad index today, up 2.75%, but you can see it is the only index that has a light green background color. And that has been the case for the last 4 or 5 days, so I don't want to make it seem like that's all of a sudden different or changed. It still is the case, but what is worth noting is the fact that it is the only one doing that, and the other 3 are not. And remember, for a while, during this kind of stretch right here, in mid to late January, the Russell 2000 was actually one of the worst performers there. So there's been some pretty decent stabilization here in the Russell 2000. You put in that low at 1901, and we're up here at 2076 right now, and just on the cusp of potentially, crossing up and through that moving average. Now, if it happens, keep in mind that over here, we also saw it cross up and over the moving average, and that didn't really lead to any sort of enthusiastic follow-through for the small caps. It ultimately was an excuse to sell rather than an excuse to buy there. So we've got to be a little bit cautious in our mindset, but we also recognize that if there is some sort of a recovery in the market, it has to start somewhere, right? Every market rally throughout history has had to start somewhere. And while every kind of bump up and through the moving average may not lead to a trend change, when there is a trend change, you will see that it was associated with one. So you might have 3 or 4 attempts at it. One of them could very well hold. Whether it's this one or not is anybody's guess. My gut feel is still the same thing that I mentioned to you guys last week, which is, I think we got work to do. I think this is a tough market that we're in right now. There's a lot of broken charts out there. There's a lot of broken spirits out there as well from market participants that hold a lot of, innovative and disruptive types of companies. I taught my dividend growth investing class here earlier today of my premiums members, and was trying to remind them that, hey, we should all feel fairly blessed as dividend growth investors compared to other segments within the market, because there's some other segments out there that have really struggled down, 30, 40, 50, 60%, that type of thing. So it's been real touch and go. You guys don't need me to tell you that. So until proven otherwise, I think this is still a market where you need to practice some hesitancy and some conservative mindset, and not get overly bullish to the upside unless you see further progress on the charts. And right now I see a whole bunch of moving averages that are still tilted lower, and therefore path of least resistance is still to the downside. But credit where credit is due, and Russell 2000 there with a weekly bullish posture. All right, let's go ahead and take a look now at our 3 green arrows charts. And hang on just a second. Where is it? There it is. 4D is the chart number there for those of you following along at home. And here we got a little bit of a mixed bag. We've got one chart that is 3 red arrows, and that's the Dow Jones Industrial Average. We have one chart that is 3 green arrows. That's the Russell 2000. And then we've got a couple of charts on the left-hand side here that have a mix of green and red arrows. So all of a sudden, we're starting to see some differences amongst our various charts here. Now, keep in mind that the Russell 2000 just barely has 3 green arrows, and the only reason it did is because it had that little push at the end of today's trading session to just get barely above its moving average there. But remember, it's basically sitting right on it right now. So even if it was down just fractionally tomorrow, that 3 green arrow signal would go away. So we don't want to make too much of it, but at least some progress there to be aware of. So all in all, we remain in a pretty choppy market If there is a direction to most of these charts, from my opinion, that direction is still down. We don't have a directionally bullish index at this moment in time. And I am going forward here, at least in the near term, with the assumption of more choppiness to the side as opposed to aggressive movements up or down. And if I were pressed on it, if somebody asked me, where do you think the markets will trend if there is a trend, I would probably lean a little bit more bearish trend at this point. It doesn't necessarily mean that we have to go into some prolonged bear market or something along those lines. It just means that right now we are struggling. We have to deal with it, the best that we can, and kind of wade our way through some of these more difficult periods. Hopefully, focusing on maybe higher quality stocks or different things like that. However, it gets you by. Some of you might need to build up cash, right? Some of you might want to go into alternative asset classes, perhaps like gold as an example. We were actually talking about gold earlier today in my dividend growth investing class as we pulled up Warren Buffett's 13F filing and some of the transactions that he's been making. And he's not one that owns any gold-related assets at this moment in time. And so that's not something he's necessarily looking at. But perhaps folks that are a little bit more concerned about inflation might be kind of heading towards gold at some point in the future. So something to keep on your radar there if you're just nervous about the stock market in general. There are other asset classes that you can keep your eye on. Let's step away from the charts for a moment. I always like to get a chance to say thank you to those of you that help support these market outlook videos. As I always say, as long as we're up and over 100 likes, I'll plan to do a full-length video for you there and make sure that it comes with a trade application example and all that good stuff as well. If we're under 100 likes, then we would just do a 15-minute quick hitter video on the major market indices themselves. So we're up and over 100 again, and guess what? You guys have done that for me every single time here in calendar year 2022. So great job there. There hasn't been one time you guys have failed me on that. So amazing work. Appreciate that core group of 100 of you that do that for me time and time again. Goes a long way in our own minds as to whether it's worth it for us to give up the 3 hours of our day that is required to do everything that's involved with this video here, where we don't make any money off of advertising or asking you to join our Patreon or anything along those lines. We're just here to give you education, and hopefully you're on the flip side willing to support us through that. So the best way for you to say thanks to us, just simply click like there for us on Twitter. Keep up the great job on that effort. Earlier today, as I mentioned, we did have our dividend growth investing class where I concentrated on the healthcare sector. So that class has been posted to our Trading Rooms calendar up above here for those of you that are Plus and Premium members. David taught his directional option strategies class, so check that out as well. Tomorrow morning, we'll be back in action with my factor-based swing trading class at 11 a.m. Eastern Time, and then David will be doing his options inventory trading at 2 p.m. Eastern Time. So lots of great content coming your way tomorrow as well. Let's take a peek here at our sector selector. A reminder that I put this together on Friday evenings. And so it is a couple of days stale at this point, but still gives a general idea as to what's happening from a sector perspective out there. Now remember, the way that I gather up the statistics that populate this particular tool is on an equal weighted basis rather than a market cap weighted basis. So that could have an impact. And I also use a multi-time period approach where we're weighting the more recent time periods like the 1 month a little bit more heavily than the further back time periods like 6 months. So with that in mind, let's take a look at any movements that might have taken place here week over week. We do have energy continuing to reign supreme up there at the top. So I guess that's your Super Bowl champion Los Angeles Rams up there at the top. And then we've got our Cincinnati Bengals coming in at number 2 there, aka the consumer staples. I suppose that is appropriate considering one of my favorite consumer staples companies is Procter & Gamble, of course, headquartered there in the great city of Cincinnati. And congrats to your Bengals there as well. Tough way to end the season, of course, but you got a lot to hold your head high about. That was was a tremendous team that you put together there. So Procter & Gamble and Kroger in those Cincinnati city limits there, maybe helping the consumer staples along. In terms of who is on the bottom side of the graphic, note that the information technology sector finds itself in the dead last position again. Remember a couple of weeks ago when I told you about that, that was the first time in this tool's 4-year history that we saw the technology sector dead last. Now it got off of dead last the very next week. It got to second to last, but now we fell right back into that last place again. That will have a little bit of an impact on my trade application example that I share with you tonight. So put a pin in that. But in order to go to the last place, it had to replace something, and what it replaced was consumer discretionary. And you can see consumer discretionary popped up to that 9th spot here week over week, perhaps assisted by some of the strength in those automobiles that I had mentioned previously. Also, like I mentioned to my dividend growth investing class earlier today, seen a couple of announcements from the auto parts companies that are worth mentioning from a dividend growth perspective. Advanced Auto Parts increased their dividend by like 50%. And then we also saw Genuine Parts, the company behind Napa, which is also a dividend king. In fact, they have 60 years in a row of dividend increases. They increased their dividend by 10%. So that's a very strong increase for a dividend king there as well. So perhaps some of those auto-related names assisting within consumer discretionary. In fact, I should also throw in Whirlpool. Whirlpool also came out yesterday with a very impressive 25% dividend increase. And of course, Whirlpool would be one of those classic consumer discretionary companies. They're trying to make, washers and dryers and, dishwashers and all that kind of stuff there as well. All right, let's go ahead and get back on track with some charts. And let's do some 12 grid analysis. And I'm going to start with chart 5A in this particular case. Remember, this will be our asset class 12 grid. So this will include things beyond just the stock market. And as you can see here, we've got a little bit of a mixed bag in terms of pink versus green charts. The green ones, of course, mean that we have a bullish intermediate posture using the market forecast technical indicator. And the bearish charts would be the pink ones. And so let's go through some of the information here today. Of course, one of the biggest stories of 2022 continues to be what is going on with interest rates. And interest rates did spike yet again today. In fact, this is a new multi-year closing high on interest rates, or at least for the 10-year Treasury yield. Remember, the way that you read this on the Thinkorswim platform, when you're pulling up TNX, you would just move that decimal point over to the left one. So this would be basically a 2.04% interest rate on the 10-year Treasury yield. So, it's getting more interesting, as I mentioned to you guys last time. I mean, we might actually start seeing some of those high yield internet banks starting to pop up and get a little bit more interesting here going forward, if there's a little bit more juice behind the interest that they can offer the potential investors out there. At this moment, I still prefer dividend stocks. A lot of them, high quality ones, can still be found with nice yields of 3 and 4% that also grow throughout time. Nonetheless, folks that don't want to take the risk of the stock market might very well find something to find with a CD down at the bank in the coming year if interest rates do continue to go higher. So that is the big story. Now remember, conversely, when interest rates go up as they did today, treasuries themselves go down. And TLT did close today below 135. Now remember, I have a trade on this right now, and it is likely that I'm going to lose money on that trade. It's going to expire this Friday, and I think the trade that I did was selling the 139 put and buying the 137. So if we're below 137, I'm not going to lose any more money. That was my built-in hedge there. But the reason I'm bringing that up is, remember, if any of you also have that trade on and we get some sort of a pop higher in treasuries between now and Friday's close, you don't want to let that trade expire in between your strikes. In other words, between 139 and 137. Otherwise, you might end up having 100 shares of TLT in your portfolio come Monday morning. So you do kind of have to babysit those options positions a bit more than your normal stock trades. Right now, if this was Friday afternoon, they would just be flushed out of the system. It would be max loss, but you wouldn't have any additional responsibility. So again, pay attention. Make sure that TLT does not close somewhere between 139 and 137 if you had a similar trade on. So it's sad to see that one didn't really work out the way that I wanted it to. But thankfully, we've got some other trades expiring this Friday that are going to be winners for this presentation, including that CF Industries trade, that agricultural kind of chemicals play, and then also Corning is another example of a trade that should work out for us here come this Friday, as that should roll off our books at max gain there. So make sure you're babysitting your portfolio, particularly options traders, as this is expiration week for the month of February. All right, beyond interest rates, let's see what else was cooking today. Commodities had been cooking, but not today. They took a little bit of a breather. You can see oil was down about 3% today as we're de-escalating tensions between Russia and Ukraine, and the same thing can be said there with gold. Gold was down nearly 1% here today. However, despite both of those pullbacks in those two key commodities, notice that the background colors of both of those charts remain dark green, telling us that we still have a strongly bullish posture in those particular areas. The US dollar has been more of a sideways performer. As you can see with this chart in the lower left-hand corner here, the dollar was down 0.39% today, as this was more of a risk-on type of a market here today. There was a lot of animal spirits running wild, and on a day like that, usually a dollar that sometimes has a bit of a safe haven status gets sold off to fund investments in more exciting areas like consumer discretionary or what have you. And so kind of a non-event there today for the dollar. It is sitting right on its 30-day moving average, and it does have a weekly bullish posture. But again, I think the defining characteristic of this chart right now is how sideways it is, not necessarily how directional it is, right? We could get away with saying that gold is becoming more directional now to the upside. Oil has been directional to the upside for a long time, and interest rates have been as well. So the dollar does share a light green color there with the dark greens of the others, but that is more in reference to the fact that it's just mostly meandering sideways as opposed to actually going into a significant uptrend like the others. In terms of other charts, I was happy to see Bitcoin continue to stabilize here, right? I've been talking a bit more about that here in the last month and a half or so, as it had approached last summer's lows, and I thought there was a pretty decent chance at these lows right here in January that if it could hold those levels, that would be a strong technical point for that cryptocurrency, as it might be looked back throughout the lens of history as a bit of a double bottom there, somewhere around that $33,000 level. So we've gone up from $33,000 up to $44,000 here in the last couple of weeks, and the nice thing about it is it doesn't look fleeting at this moment in time. And what I mean by that is, notice that we have spent probably about a week to a week and a half above this moving average now, right? There's always that risk that you have a quick little pop higher, it spends a day or two above it, and then it just goes right back into its downtrend. You can tell that Bitcoin is being much more stubborn this time around. And the other thing I would point out is I think Bitcoin has actually been acting a bit better than like your growth stocks here in the last couple of weeks. Remember that there was a stretch of time during this big meltdown period of Bitcoin here where Bitcoin was basically kind of falling in line with other growth stocks. But to me, it seems like Bitcoin kind of bottomed before the growth stocks did here this most recent time period. And the fact that they're holding their levels above the 30-day moving average, we know that the NASDAQ composite isn't doing that. So I think that's a healthy sign there for Bitcoin. I look forward to seeing where that can take us moving forward. It does have a strongly bullish posture at this moment in time. Speaking of which, EEM also has a strongly bullish posture. Remember, EEM EEM is a way for us to gauge what's happening in the emerging foreign stocks. I saw, for instance, Alibaba, a trade that we did a while back, do quite well today, and I also saw some of its competitors like JD.com do well, and even Baidu, doing pretty well. So, don't fall asleep on some of those Chinese names. While China is a little bit of a hot button issue, remember that they took their lumps a lot sooner than we did here in the United States. And so that could also mean that if there is a reversal to come, they could very well be the first ones emerging out of those doldrums before the U.S. tech stocks do. So I think that really assisted EEM in this case. EEM was up 2.17%. And remember, that's more of a risk on area anyway. If you want a big bullish day, then you'd prefer to see EEM outpacing EFA and SPY, and that was the case here today. So I think that's a good sign there. You can also see that not only do we have a strongly bullish posture on EEM, but that moving average also turned green today, meaning that price is now above a rising moving average. It's just barely rising, but nonetheless, you got to start somewhere. So is that a good-looking trend on EEM? No, I wouldn't say that, but at some point, if a reversal is to happen, it's got to start somewhere, right? And this could very well be the building blocks of that infant, trend reversal that could be taking place overseas in some key areas. All right, let's go ahead and take a look at our sectors now. And this will be chart 5C for those of you following along at home. Now keep in mind there's only two charts here that remain green, and that is energy, which was our worst performer today. Mentioning before that the price of a barrel of oil was down, so it makes sense that the producers of that oil were also down. So that was the only key sector that was down over 1% here today. Materials don't have a dark green background like this one does with energy. So that means that we have a weekly bullish posture there, and that might be partially due to the fact that materials were up pretty nicely today, up 1.84%. The problem is materials still remain below their falling 30-day moving average. So as you look at all of these charts, energy is the only one that has a green background and a green moving average. In other words, this is the best looking trend of the batch, and that should not come as a surprise because that's how it's been for the last several weeks. So despite the materials getting a nice little boost from a psychological perspective, I suppose you could say, with that weekly bullish intermediate posture, I'm not sure I would be like a big cheerleader for that group here. Now, there could be interesting areas within there, right? Maybe your gold miners or what have you could be doing a little bit better. But for the most part, I think that the materials chart does have a lot of work to do. I'm still holding out some hope that the financials can kind of gather themselves. Notice that the financials do have a green moving average, telling us that price is above the moving average, but they do have that light pink background color, so we do have a weekly bearish posture there. But I think that's kind of the one that right next to energy has a decent chance of actually trying to carve out a legitimate uptrend. A lot of these others kind of give me more of an impression that they're kind of rolling over, right? If you were to look at something like utilities, we're basically sitting at 3-month lows at this moment in time, just a hair above where we closed here on November 30th. And the same thing could be said really with real estate. Yesterday was a 3-month closing low on real estate. So those two have rolled over pretty violently as a result of their interest rate sensitivity. Remember, when interest rates go up, all else being equal, utilities and real estate struggles on a relative basis, and you usually give a little bit of a positive impact then to the financials who earn a little bit better net interest margin there. But even beyond those two interest rate sensitive areas, there's still a lot to be desired here. I mean, look at that communications chart. It looks like it's stuck in a prolonged downtrend. Look at the technology chart. It looks like it's stuck in a prolonged downtrend. You've got that with discretionary. You can make that case with industrials. You could probably get away with saying that about healthcare. And I had been a little bit more optimistic about staples a week ago, but even now, Staples look like they're kind of struggling here all of a sudden as well. Now they're still trading close to their moving average, so that could certainly reverse course within just a couple of days. But this is not the type of behavior that you get excited about as a potential trader there. Perhaps that'll open up better opportunities. Those of us that are dividend growth investors, you'll recall that consumer staples make up the largest portion of the dividend aristocrat list, and when prices go up, dividend yields go down. So if there is a give back in staples, the good news there is dividend yields will go back up again and perhaps become a little bit more interesting from a longer term perspective. So for the most part, it's not good looking charts out there, despite what on the surface look like a great day. And don't get me wrong, we're happy to have it. But if you kind of take a step back and ask yourself honestly, do these charts look good for a big bullish run in front of us? We got work to do. At least that's my impression of the situation. And you might disagree, and that's fine as well. But to me, it looks like we've got more bearish charts than bullish ones here. And so I want to be respectful towards that. I didn't mention it specifically, but let me address the fact right now that real estate does have its second straight oversold cluster signal here today. And so perhaps maybe due for a little bit of a dead cat bounce. Remember, those usually don't lead to trend changes, but might get you back up towards the moving average a little bit closer in due time. All right, let's go ahead and get into our trade application example here for the night then. And again, note that technology is in a strongly bearish posture at this moment in time, in addition to being dead last on the sector selector, as I mentioned before. I'm bringing that up because our trade application example tonight will be one of the poster children of the technology sector, and that is Microsoft. Now, I have no idea why the chart looks like this. Hang on a second. What is up with that? Don't know what happened there. A little bit of a glitch in the system apparently, but let me try it again. There we go. That looks much better. Here's Microsoft. So Microsoft, obviously, just a legendary company, one that we've had the good fortune of buying in my dividend classes over time. We've also had the good fortune of buying it in my trend trading classes. In fact, it represents one of our coffee can positions in that trend trading class, meaning that it's more than doubled its money for us. We sold half of our shares. In fact, this one was a very fortunate one. Just out of sheer luck, we literally sold half of our shares on this day back on November 22nd. We didn't know it at the time, but in hindsight, we sure feel fortunate to have liquidated half of our position on that particular day. So I don't want this to come off as, oh, Brandon doesn't like Microsoft. I'm a huge fan of Microsoft. It's a legendary company. But in this particular case, I think we can also see here that Microsoft has been struggling in the last couple of months, right? This looks like a chart that has been in a downtrend. And so what I ended up doing here today was selling a bear call spread on Microsoft. I believe what I did was the March 315s that I sold, and then I bought the March 320s. And so remember, if you're a premium member, the trade's already been done during the day, and I've sent out all the trade application examples and trade details and all that to all of you who are premium members of Market Scholars via the Telegram app. So feel free to check the strikes and the execution prices and all that on the app if you need to. But the general idea behind the trade is it's a moderately bearish trade, and I want to stress that. Remember, a couple of weeks ago, I did a long put vertical, and I did that on Danaher. And by the way, that one has done tremendously well. In fact, Danaher was one of the 20% of components within the S&P 500 today that finished lower, so I feel pretty lucky about that. It does have an oversold cluster here today, so perhaps there's some room for a quick little snapback there. But in this trade, it was a more aggressively directional bearish trade, and it's done fantastically well for us thus far. With Microsoft, notice I'm not doing an aggressively directional trade. I'm doing what's known as a bear call spread. And for those of you that are not familiar with that options technique, basically I'm creating a credit up front with the sold strike. And as I mentioned before, 315 would be my sold strike. The 320 is purchased as part of that trade, but you can think of that as our built-in hedge. And the reason that that could be useful is if I'm just completely wrong about this trade idea and Microsoft just erupts higher, way above 320. It's kind of the same mindset as what we've got going on with TLT right now. That in that case, it was a bull put spread, but it's a credit spread like this one. It's just the opposite direction. And with TLT being well below 137 right now, that long 137 put is acting as a hedge within that spread. So in this case, the same thing would be happening. It's just that it's on the upside as opposed to the downside. So in other words, to me, Microsoft still looks like it is stuck in a downtrend for the time being. But if I'm wrong about that, and this stock goes well above 320 between now and March expiration, then I am protected anything above 320. But what I want to have happen in this trade is for the stock to stay below 315. That's where I make max gain in that trade. And with these types of trades, we usually target about a 30% return on risk. So you can have the opportunity for okay rewards, but you're not going to, have a spectacular quadrupling of your money or something along those lines. It's really just something to kind of bide my time, right? I kind of feel like we're in this market right now where it wouldn't be surprising in the least if we got a further pop higher in the market in the coming days, but I am still worried about the market trends in general. And remember, in a lot of ways, Microsoft kind of represents the market, represents the S&P 500 as the second most important component within that index. And so for the most part, I do think that there is still selling pressure within the system. And this is one way where I can try to kind of sprinkle in some bearish bets along the way. Again, it's not as aggressive as I was with Danaher, but in this case, at least have some balance within my portfolio, which otherwise has a lot of bullish trades in there. Remember, we've been doing tons of sold put trades here lately. Those are bullish trades. So by entering in, a bearish trade here, it maybe helps me feel a little bit more comfortable with those other trades that I've also got to manage within this presentation's paper money account here. So as you can see, we do still have a strongly bearish posture there from an intermediate perspective on Microsoft with that green line at 37 and falling, and obviously we remain below that falling 30-day moving average as well. Another thing that kind of caught my eye with this one, it's not a big deal, but just from an educational perspective, I'll mention it nonetheless. They are going to pay their dividend tomorrow. I shouldn't say pay it, but the stock is going to go X date on their dividend tomorrow. And so what that means is, all else being equal, 62 cents will come out of the price of this stock. And so it closed around, $300 here today. So it might open up tomorrow at closer to, let's say, $299.40 or thereabouts. And so that's a little bit of a benefit there in that case. Remember, I could have also made the decision to short sell Microsoft. But in that case, if you're short selling the stock itself, you are then on the hook for paying the dividend to whoever you borrowed those shares from. When you're doing an options trade like I'm doing here, I don't have to pay that dividend, even though I'm still doing a bearish trade on this particular underlying security. Okay, so Microsoft continues to be in a bit of a downtrend. Technology dead last on the sector selector, still struggling from an intermediate posture as well, and just wanted to kind of sprinkle in some bearish trades there when given the opportunity for a little bit of a relief rally like we saw today to give me some better pricing on potential bearish trades. Okay, so that's what I had for you here today. Hope you enjoyed the presentation. If you did, I have one simple favor to ask out of you. Simply click like for me there on Twitter. Remember, there's really 4 different ways where you can find that tweet. You can either go directly to Twitter and go to my timeline at Brandon Van Zee, and it'll be pinned to the top of the timeline. Otherwise, for those of you that are watching this video on our website right now, remember that below the video there will be a Twitter widget that you can click on the heart on, and it'll take you to that same tweet. Those of you that are watching this directly on YouTube, Within the description area, you will see a link to the tweet in question there where you can click like as well. And then last but not least, you'll find an icon that has the Twitter logo in it on the email that I send you guys that are on the email distribution list. And if you click on that icon, it'll take you to that area of Twitter to click like there as well. So thank you very much for helping support that. It does go a long way for us. Hope you guys have a wonderful rest of the night. I'll look forward to seeing you on Thursday. Take care, everybody. Bye-bye.